Traders at UBA say they expect the bond market to trade sideways in the interim today as yields hit new resistance levels around 12.9%. Dumebi Udegbunam, fixed income trader at UBA, joins me to review this week's trading. Dumebi, thank you for taking the time out to join us today. I was talking to a market analyst earlier, and he said that, just as you have also alluded to, that we may see yields hitting a resistance level for investors. We're talking about the one-year paper that came down to 6.8%, and I was asking if this could slide even lower going forward, and the response was that it was unlikely. But what are your thoughts, and how did you arrive at this conclusion?
Good afternoon, Esther. Thanks for having me. So yes, it's unlikely we might see that, because reason being, so if the yields in the market become too low, we might see market apathy. That is, a lot of market participants might not be interested. As we're moving from a pandemic level where we had low yielding levels now to current economic growth, where we're seeing a lot of emerging markets and fixed income markets moving towards a higher yield environment. So us being on the other side of the coin might be detrimental to the success of the markets in general.
So maybe when you say too low, how do you define too low? We're 6.8%. We've been at a place where rates were at 3% and investors were still, packing into the market. So how do you define too low in this environment right now?
So, for example, if you look at where we're coming from a penultimate of 9.75 down to 6.8, anything lower than that would probably be probably close to a year's low. So yes, we've reached a point where 6.8 down to 6.5 could be the barest minimum where rates might go to. You cannot judge or compare where we were in the pandemic levels. That was a tremendous different year where we had low yielding assets currently due to the pandemic and drop in economic activities. Where we're moving to right now is economic growth, and we need to stimulate the economy, and you have to make yields attractive. So hence where we're coming from on that aspect. Okay,
we'll come back to the fixed income market if we have time. I want us to quickly talk about the Naira. We saw it strengthening significantly against the dollar yesterday at the INE window. Talk to us about how the Naira performed today, if it was able to hold that same strength, and also going forward, what your forecast is for the Naira in the coming week.
Well, we expect to see a stable Naira. The CBN has done a tremendous job actually in intervening in the invisible market, the PTA market and other markets available. They've done a tremendous job to pumping the system with a lot of FX. As you know, they've banned their sales to BDC, so the inflows they give to BDC inflows have dropped to about 80%. So where all that inflow is going to right now is to the bank, which is challenging a clear view of where the Naira should be right now. So we expect to see a stable Naira and even a further rebalancing and strengthening the Naira going into Q4.
So what would they put for you, if you can, a forecast? Right now we are seeing the Naira, at least at the last time we looked at the Naira, was 410. Talk to us about where it's landed at today, if trading is over, and if you think that it could strengthen further in the coming days.
So we're seeing it trend hover around 409, 410, just a slight difference right now, but we expect the stability to continue. By Q4, or by ending of this year, we might see a further rebound or a further upward movement and strengthening there, let's say to 407, 408, but right now, we expect stability going into Q4.
Okay, let's go back to the treasuries market. Talk to us about, going into the new week, the OMO curve, what should we expect in terms of how investors are going to play the yield curve?
Well, going into this new week, we only have 2 more days to end the month, and then we begin the new month, which is September on Wednesday. So 2 things to watch out for. One of them is the rapid or the increase in maturities compared to the previous month. We have about 618 billion maturing this month compared to 583 billion. That's on the treasury bill side. On the bond side of the market, we have about 200 billion inflow coupon payments compared to 49 billion. So we expect to see a slight bullish trend in the market. And also we have the MPC meeting coming in September too. So the month of September will be a very liquid month, bearing any CRR debits, bearing any frequency CRR debits. So we expect it to be a very liquid month, which will support bullish sentiment and also help take care of the liquidity obligations that banks have been facing.
Now, how do you think investors are processing especially the latest data that we've received this week vis-a-vis their investments. We've had the GDP data for Q2, 5%, and latest inflation data that we had showed another, still around 17% environment, but it dropped from what we had before. So how are they processing this? And of course, looking at how the DMO is trying to pull back and is pushing for lower rates. I mean, we have inflation at 17%, but if you look at the return on investment for some of these investments, it's not. I'm just wondering how investors are processing all of that. Can you help us out?
Well, Esther, I can just use one word to use and define all this, which is the base effect. Now, if you look at where we're coming from a negative 6.1 to a negative 3.2, positive 0.1, a positive 0.51, and a positive 501. However, if you look at a quarter on quarter, we had a contraction of 0.8. So what has happened right now is a rebound. That is, this time last year, we're at a negative 6.0. So we saw a rebound, which is one due to the resumption of activities. If you look at the growth sectors that we saw grow, we saw the transportation, which was close to death in the pandemic year, that's 2020, compared to where it is right now. If you look at the media and the goods and services, mining too. So all the different sectors that were responsible for this growth were sectors that were heavily damaged by the pandemic and now are recovering. So yes, it's a good movement. However, it's just a rebound compared to where the current market right now is. We're seeing a growth in economic activities, but is it transforming into economic development in general? We're still seeing high unemployment rates and difficulty in the ease of doing business. So yes, it's a good thumbs up to where we are, but however, we have to be careful and look at how we can move back to where we were pre-COVID levels and also better. On the other side, on inflation, the exact same. If you look at our core inflation, according to that data, it was at 3.07 compared to where it is right now, 3.92. So yes, there's still a heavy impact on inflation right now, but compared to where things were last year, we're seeing a slight improvement in activity. So like in all these puts, there's a rebound. However, there's still so much room for economic activities to push into development.